Okay, we are live and ready to go. How are you doing today, Emma? And how is Texas weather been for you?
So we just drove in tonight or this afternoon, just got to the RV park and the weather's actually nice. We took a walk around the park with our little dog and we were looking at a bunch of stuff and one of the residents came out and thought we were suspicious and asked us some like what are you doing? Who are you? And we thought that was great that he would speak up when he saw something suspicious. So we were a bunch of people were out just chilling. It's jacket weather.
It is jacket weather. That's good because it's nice and cold here.
Yeah.
Uh, I'm glad you got to Texas and it's jacket weather and not negative whatever it was at the earlier part of the week.
Yeah. It was a little dicey. We got stuck in Atlanta overnight, and the weather's been pretty bad. But it's just beautiful. We got our RV all hooked up to in a spot, and met the on-site management team. And like I said, went for a walk. Our dog did not get eaten by a gator, even though we were on the waterfront. It's really a great day.
That's awesome. Well, I'm excited. Hopefully, you're excited as well to get into maximizing returns for all the
Mhm.
listeners that we have out there. I'd say let's go ahead and just jump right into it. Are you good with
Go for
that?
it. Yeah, go for it. And nobody likes this banter. They're like, just give me the details.
There, you, there we
Oh
go.
wait, no, we got more details. So my name is Emma Powell. For those of you who are not familiar with me, uh, Chris and I are co-founders of Rise Capital. It's a private debt and equity fund where we raise capital for commercial real estate deals, fix and flips, things like that. It's a diversification fund for people who want to get involved in real estate, but they don't want to be flippers or landlords, that type of thing. We do the work. Like, we're not going to make you drive your RV down to Texas and live on site. So that's basically what we do on your behalf. So my background is large multifamily. I got started in real estate investing in 2018 with creative seller financing and lease options and wholesaling. And I quickly realized that I wanted to scale up to some larger properties. So we started buying multifamily apartment buildings, raising capital from our investors. We bought, I don't know how many buildings. It was close to 1,000 units between what we bought ourselves and what we bought with our investing club, and ran those. But we were still at the same time doing private lending, and we had our portfolio of single family homes and things like that. And so we realized that we wanted to diversify out of multifamily publicly. So we were already doing it in our own portfolios, but we wanted to be able to offer those same investments to all of our investors, because when things get rough, we want to make sure that we're spread out. So that's basically my background. Before that, I was a real estate photographer for almost 10 years, and I have a degree in entrepreneurial management. I should probably learn how to say the name of my own degree. This is basically teaching us how to run venture startup businesses. Oh, Chris, I think you're still muted.
You are correct. I'm still muted. I did mute myself. Um, but as I was saying, thanks for introducing yourself. Excuse me. I don't have as much of a background as Emma does. She's our definite expert and has a lot more longevity in just the real estate space specifically. I came more from a retail background, so I was the executive for a large retail chain back in where I used to live. So I'm originally from Hawaii, moved to Utah. Everyone asked why Utah from Hawaii, but it was to move closer to my kids. They moved away to military and college, and my wife and I just wanted to be closer to our kids. Um, I left the executive world. I was in the executive world for 20. It says 25 years here, but it was closer to 27 years. Where I ended up being the CEO, like I said, of a really large retail chain there. And in the CEO space, you still need to understand real estate. Real estate plays a huge part in retail. Not obviously not necessarily as much with online retail, but your typical brick and mortar stores, it's a lot. I mean, it's like the baseline for all of your distribution as well as all of the retail activity that goes on. They go on in brick and mortar, four wall stores. So understanding, I have a lot of experience on the triple net side. But since navigating from Hawaii to Utah, my wife and I, we didn't really know what we wanted to do. We started off doing half of a flip. Wife watched way too much HGTV. She was going to be Joanna Gaines, and somehow I was going to be Chip Gaines, and that lasted half of a flip. And we ended up navigating and doing something completely different. We ended up networking and meeting a bunch of individuals. In fact, our networking event is one of the networking events is how we ended up meeting Emma. Just fell in love with the whole idea of commercial real estate. It tied very well into what I did as a C-suite executive. Probably looked at more P&Ls, balance sheet than I would honestly care to admit. And honestly, at the end of the day, especially when you're looking at commercial real estate, a lot of it has to do with just understanding finances, understanding how it works, understanding how a business works, understanding operations. Is probably the more integral part of being able to operate, and invest in commercial real estate. So that's kind of me in a nutshell. And we just want to get in and be able to share and bring education where we can. So Emma, having all of her years of experience, put together a tremendous, honestly, it's an ebook that we give away for free. And what we want to do is spend some time dissecting and going through some of that education. So we can I want to break it down into a bit more simplified terms where everyone can understand, give everyone that ammunition that they need to be able to go out and confidently invest in the real estate, the commercial real estate spectrum. So I said, let's just get into it.
So I started my career basically as a graphic designer in marketing, and people would ask me questions, or I had questions, and so a couple of years ago I just started putting together these slides explaining some of the most basic terms for real estate investors to know. And this little ebook is an aggregation of a couple of years worth of answering these questions. So we're bringing these are the essential things that you need to know, like the 4 financial metrics that are the most important thing that most passive investors are paying attention to. If you're a business owner, you're running a real estate, there are dozens and dozens of details that you need to know. But as a limited partner, sometimes you can get a little bit down in the weeds and feel overwhelmed. Like, I don't know how to invest in this thing because I'm looking at this stuff and I don't know how to make a decision. So you just shut down. You're like, maybe this isn't for me, and you walk away. So we're just breaking it down to the most simple terms. So the financial metrics that most investors take into account when they're making their investing decisions. So to start out with, our fund is for accredited investors only. And if you are not an accredited investor, please still feel free to reach out to us because we can give you some direction on some other ways that you can participate. But how do you know if you're an accredited investor? When I first heard this term, I started looking online for the exam that I could take, but there's no exam. And you may not be laughing because maybe you thought it was an exam too. I mean, I certainly did. But basically what it is some tests that the Securities Exchange Commission came up with to make sure that people were qualified to invest in these private placements that usually have higher minimums, like $50,000. They want to make sure that people are financially sound enough to withstand any kind of risk that they might be undertaking. And so an accredited investor is someone with a net worth of $1 million or more. And a few years back, they said that can't include your personal home. Basically, that was their way of combating inflation. They also have an income threshold, which is a $200,000 per year if you're an individual, or $300,000 per year if you and a spouse are combining your income. If you make $200,000 a year by yourself, and your spouse does not get you over that 300, you would still be considered an accredited investor, even though your spouse would not be. You could still invest in these deals together. And so basically what happened a few years ago, again, they're trying to break open the world of these kind of private placements and make capital more available for small businesses, and also make these investments more available to more of your Main Street rather than Wall Street investors. So they added this professional license to it. So if you have some sort of a financial planner or securities license, Series 65, you work for a company that does something similar to what we're doing, and you're a knowledgeable employee, then you are also considered accredited and can invest in these types of deals. And stay tuned because they're always fine-tuning this. They may have some expanded definitions coming up soon. So if you're not accredited now, again, just keep in touch as things change, or even if we're able to start offering things to unaccredited investors, you have a lot of options. So the first thing to know is if you're accredited, and that determines what kinds of deals that you're allowed to look at.
Just more of a curious question. Have you heard of some of the newer and updated legislation that are coming out that would impact if they're accredited or not accredited?
A lot of rumors, some House bills that are coming up. I think people get a little bit excited. It's like daylight savings time. It's like, oh, daylight savings time has passed, and we're not going to have daylight savings time anymore. But it only passed the House, and then the Senate did nothing with it. And so you have to make sure that when you're looking at these kinds of things, that it passes both houses and it's actually signed into law. So there's a lot more. Just when a bill passes the House, it has to pass something else. So that's really what's going on right now, where there's some House bills up saying that they're going to raise the limit for an accredited investor to something like $10 million, and then introduce an actual test. So you'll have a certified investor, and it would be something that the SEC would offer for free for anybody who wants to study and pass this exam, to basically say, I want to be able to invest in these things no matter my net worth or whatnot. If I can pass this test, I can invest in this thing. And so again, it's a way to crack open the capital markets for smaller businesses that have typically had a very high barrier of entry for raising capital for smaller deals, because it's expensive to set up the legal structure that you need. And so some of the smaller operators are just needing to get more breaks. And they've made a lot of changes. I remember when I first started in 2018, the accredited investor being able to actually advertise these deals to accredited investors, that was fairly new. I think the law was passed in 2013 and took effect in 2015. I'd have to go back and look that up. 2021, you saw some of these changes. We have now additional reporting and additional audited financials. And so things are always changing a little bit. I would love to see some sort of an exam. Accredited investor now, $1 million is really not that much compared to how much it was when these regulations first came about. So if they were to raise that to something like 10 million, it just means that somebody with that kind of net worth is more insulated from the little shocks if every deal doesn't go perfectly. And so somebody who's able to take an exam should be able to show that they have knowledge to be able to invest in these things. So I actually am in favor of that. But again, it's several different House bills and nothing's really gone anywhere yet, but they are constantly tweaking it to make things more available.
Well, regardless of that, I have my fingers crossed for getting rid of daylight savings. Again, from Hawaii, never had it most of my life. It's just awkward having it here, but
Yeah,
that
don't
was
get your hopes.
definitely a great explanation, though. I love it.
Well, some of the things that investors really need to be concerned about before we even get into the financial metrics. So you'll see that number 3 is the deal, and that includes location, location, location. So the returns and the deal itself, where it's located, how it's doing financial, is actually third on this list. And the reason why is because, as Chris was saying before, managing a business and running a business and the team's experience and their ability to take a good deal and make it an exceptional deal is the top priority. You need to trust the people you're working with, that they are going to do what's right, what's legal, that they're not going to commit fraud. If things get hard, are they still going to continue to operate on the up and up? Do they know how to run a business? These businesses are detail heavy. I think when multifamily was really becoming like the darling of the investment world, it was almost like the Bitcoin of real estate. People were jumping in and they didn't really know what they were doing. They didn't have any business management experience or background. And so it created some sticky situations for some newer operators who found out that running these things is a lot harder than just owning a couple of rental houses. And so that team experience and that team's ability to execute a business plan is really key. And the saying that we use is, a good team can take a bad deal and maybe make something out of it, but a bad team can ruin any good deal. So you don't want to get into a situation where the team doesn't know what they're doing and they take a good opportunity and basically turn it into something that none of us want to be involved in. That's why we have that number 1, the asset manager. Number 2 is, again, it's the location where the deal is. I think I said location was number 3, but location, there are 2 locations that we often talk about. It's the market and the submarket. So the market would be something like Dallas, Texas. And then the submarket would be the Highland neighborhood or the Highland area of Dallas, Texas. And so it's very important to understand that not everywhere in a city is created equally. And it is obvious to us when we're driving through and we see good areas and we see not so great areas, places where you'd want to live and places maybe you wouldn't want to live, places you want to shop and maybe places you wouldn't want to shop. And so it's the same way in real estate. It can be very oriented towards these smaller niches. And so understanding the neighborhood and having a team that spends a lot of time in that area. I'll give you one example. We had a deal where it was struggling a little bit. And so we ended up hiring a new property management company than we normally would be using that was specific to that city. And they were able to turn the property around. They just knew places to advertise, they just knew how to talk to the local clientele a lot better. So understanding that neighborhood is really critical. And number three is where we're going to spend most of the rest of this presentation talking about the actual returns that people are looking for. So number one and number two could be webinars all on their own. Today, we're focusing on the financial metrics.
Okay, kind of jumping in and understanding. First is, what are we selling? What do other syndicators sell? What is private equity selling? It's kind of broken down into the question that you can ask yourself is, what is a security? And then a security is defined under the Howey test ruling. And then I forget, I remember when someone first mentioned it to me, I was like, what is a Howey test? I had no idea what it was. But you go back and look at into like historically what it is. I mean, there's four components that they look at, and the four components are: is there an investment of money? Is that investment in a common enterprise? And does that investment come with the expectation of making profits? And are that profits to be derived from the efforts of others? If it falls into any one of those four criterias, it passes the Howey test. And then again, going back, I don't know the exact date. This is definitely before my time. I
Yeah,
think it was in
1930s,
1946
yeah,
or 7 or
long
somewhere
time.
around there. The SEC
Movement.
was in a civil case against shoots, I don't even know the actual name. Is W.J.
Mhm.
Howey, I believe. The story is interesting though. So what it was the Howey, it was a corporation, is the Howey company. Again, WJ or JW Howey. They actually had plots of land in Florida. There were citrus farms in Florida. They would sell the property to get income capital in, and then they would lease back that property from the owners of the property. Most of the owners had no idea how to had any idea of agriculture. So it was more of a way for them to get money in. And during that court case, again, it was ruled that that is the selling of a security. So real interesting concept. I mean, there are a lot of people. So when you look at a security, there's two things. There's in the private equity market, it's a registered security. So they're registered with the SEC to sell those securities. The other way to actually sell a security is to file and sell the security under an exemption. And we can honestly have a whole another webinar on just the
Yeah.
exemption, because there's a ton of them out there. But those are typically the only two ways that you can actually sell a security. You guys, I would want to kind of put it out there. There is a lot of people actually selling securities that are not falling under the two. And technically, it's against the law. It's not necessarily against the law for you to buy the security. It's against the law for them to sell the security. So again, that's what the JW or WJ Howey company was doing back in the 1940s. And again, at that point, it was like, okay, this is not legal. We have to go through. And it was exactly what Emma was saying earlier. It was more set up to protect the investors out there, to making sure that, okay, the people that are actually selling these securities, they're doing it more. It's a legitimate legitimate security, and that they have some kind of, they're more ethical in the way that they're doing it. So there's just some things that you guys want to be cognizant of and understanding. If you're going to invest, is it a security? And one, are they registered with the SEC? Which, if you're registered, you're on the securities and the market, the exchange. Or two, do they have an exemption? Again, it's typically what you're going to see is a Reg D exemption. And I would say most commonly it's a 506C or 506B, but there's others out there.
Well, and this goes back to what we were talking about before with the team. If your team doesn't know these regulations, I know probably some people are like, your eyes are starting to glaze over and what's a security? But if your team that you're investing with isn't doing this correctly, you have to ask yourself, what else are they not doing correctly? So this is one of the first litmus tests that you as an investor can ask the team, and just be a little bit aware of what these laws are to make sure that they're following the laws.
Yeah, yeah. Well, when we spit up these slides to cover, Emma took the juicy ones and she gave me the boring legal ones. So I got to cover the boring legal ones. And she's beautiful about throwing those tidbits in, but she's 100% correct. Is understanding the who is running the asset, and making sure that, honestly, at the end of the day, making sure that the values align and they're doing everything legitimately and within the statutes of the law. This kind of goes into the same thing. So the partnership types, they're basically the legal structures of the entity and how the entities are set up. These are not unique to these structures are not unique to syndications or private equity. You can go and get partnerships have been around forever, since the 1800s, I believe. Um, and the structures of the partnerships have been around a very long time as well. This is the typical structure that you would see, the legal structure that you would see in a typical syndication or a fund, where you're going to have the manager, GP, or sponsor. They're all the same thing. And then they typically have, normally they're going to be the one operating the assets. They're going to have the day-to-day operations. They're managing all of that fun stuff. And then you have the limited partners, which the limited partners, they normally don't, I mean, they're normally not going to do pretty much anything. They normally don't have voting rights. Sometimes you do. I mean, I would definitely look through the PPM, or the private placement memorandum, or the legal documents, to see what kind of voting rights you have. Some do, some don't. But I think the biggest part of it is the liability is only limited to the amount that you're invested. So say somebody sues the facility, and it's a large lawsuit. That lawsuit is only limited to the general partners and insurance. None of that would flow down to the limited partners. The limited partners are their only liability is the amount that they invested. So that's a important distinction to have out there. But again, you can set up these limited partnerships. I mean, a good example would be, I'm just trying to think of off the top of my head. You own a business and you want to be able to put your, I don't know, for tax reasons, you want to be able to put your kids as ownerships of the business. You could theoretically do it and have them just be limited partners, not really have any say of it, but then they'll get you can even configure it a ton of different ways. Just, this is, again, this legal structure is not new. It's been around forever, but it is pretty typical of what you would see in a syndication, a real estate syndication.
All right. This is one of my favorite metrics, because if you're going to say equity multiple, basically what it is how much money am I getting? And so if you want to break it down very simply, and the example that we have, let's say you invest $100,000 and you put that money in the deal, and 5 years later you get $100,000 back. That would not be a very good investment. It's basically a 0% return, because you got back your original capital and that was it. So that would be a 1x. So you got back what you put in. You didn't lose any money, but you also didn't make any. Now, if you are doing a 1.5x equity multiple, that means that the original capital comes back $100,000 plus $50,000. So you've 1.5 times what you're doing. And the 2x, obviously, if we're going to take the same example, you put $100,000 in, you get $200,000 back. This return can come through the form of cash flow during the investment, or it can just come out at the end when the asset is sold. Just like a stock, some of them have dividends, some of them don't. You don't make any money until you sell. And the thing that's important to remember about equity multiple is, how much money am I going to make, is only one question. The question that it does not answer is, how long is it going to take me to make that money? So equity multiple is often a favorite darling of investors, and it's fascinating. It's a really useful metric, but it doesn't take into account the value of time or the time value of money. How soon are you getting it back? How fast is it coming back? Are you waiting till the end? Is it a lot of cash flow up front? Those questions are not answered by equity multiple. And that's the one thing that I want to make the most clear as we're talking about these financial metrics, is there are top 4 that are most commonly used that we're covering, but they really need to be taken in as a whole and how they relate to one another. And I think that's where most people get lost. Equity multiple is pretty simple. How much money am I going to get back? How much money am I going to make on this deal?
Yeah, that's a good point. As we're going through this, and we're only going to cover a handful of them. There's a plethora of different financial metrics that you can use, and we could definitely get into the weeds going through all of them. I think we're going through the top ones that are probably the most prevalent and the most widely used out there. And Emma brings up a really good point. Like, someone should never go into an investment just understanding one of these metrics. That you guys need to put all of the metrics together. And the other thing to the other kind of component on it is that everyone's honestly on a different investment journey. So based off of where they're at in their investment journey, they might be looking for different things. Equity multiple might be important for someone as opposed to an IRR where they or a higher IRR where they want their cash up front. It's all different. There isn't any one metric that's going to silver bullet and say this is the most important metrics, because again, it could be different for everybody, and you have to put all of them in totality. And equity multiple, I love as well because it's super easy to explain. Just 1x, 2x. I mean, very easy.
The hard
and
one.
then Emma gives me the one where I don't even
made this slide.
I don't even know how to draw this.
We're not even going to get into the sigma part of this. Don't get freaked out by this ugly, gnarly equation. It's actually
no one uses this. Just FYI, no one uses this. We use Excel. There's a IRR equals, and you just highlight all the numbers. Like I can do this calculation in seconds on an Excel. So I have actually never manually calculated. Have you ever manually calculated? Yeah, I don't think anyone's ever.
I tried once.
I did try once as well, and I gave up. So, but it is. So the IRR is probably one of the most widely used metrics in real estate investing, bar none. It's definitely used by large private equity firms, and something that people really don't realize. I'll maybe talk a little bit more about it later. IRR actually does drive values of properties. And I'll explain that. So when you're looking at the IRR, as Emma said, it's more of a time value of money. And then you think, what the heck is a time value of money? But I think the easiest way to break it down is, if you think about it, we deal with inflation and we're investors. So we're investing. So $1 received today is worth more than $1 received tomorrow. Because again, if I get $1 today, it's not impacted by the inflationary rate I'll see tomorrow. And if I get $1 today, I can invest it today as opposed to investing it tomorrow. Because if I'm getting a 10% return on the money I invest today, it's going to be more than if I invested tomorrow. Again, best time to invest was yesterday. So just thinking about it in that aspect. So even like if I apply that to just real estate or my investments, the cash flows distributed earlier in the investment will yield a higher internal rate of return than cash flows received at the tail end or a later distribution. And hopefully this is all kind of making sense. It sort of does. Now, when I'm looking at the IRR, so I'm looking at a deal and they have the IRR, it just goes back to exactly what Emma said. Don't just take one metric and look at it, because if I'm looking at a deal, so I'm looking at a pro forma and I'm seeing, is this a deal that I want to invest in? I was like, wow, it has a really high IRR. But then I look at it and then there's maybe your typical hold time, your typical pro forma hold time is somewhere between 5 to 7 years. But this deal has an exit in 3 years, or it has a refinance in 2 years. That will automatically, innately make the IRR look higher, but it might not have been as good of a deal if it was held on for 5 years. So you have to understand that every metric has its flaws, and it should, exactly what Emma said, it should be looked at in totality. Now, but the IRR is very important, because think about it from the private equity. So these large private equity groups, right? They create this massive fund. I think Blackstone's last fund was 15 or 20 billion dollars, right? These large funds, and in these funds, they're promising a 12 or 15% return, an IRR based off of what they're going to invest in. Now, if again the IRR is the return of the entire profit, so if my profit drops by rising interest rates, just let's go with specifically rising interest rates, that's automatically innately going to drop your IRR. Now, the only thing that BlackRock can do at that point, or these large private equity firms can do at that point, is purchase, and they're going to have much larger purchasing power. So they're going to go and impact the total market by offering less and picking up properties for less. And I think a lot of times people don't look at how it fundamentally works in totality. So it is, I've heard it before, because people don't understand what the IRR is, they kind of blow that metric off. and they just concentrate on the equity multiple because it's super easy to understand, but not fully understanding the whole component behind it, because it can be a powerful metric if you fully understand what you're looking at in the numbers and can combine the numbers with different metrics. Anything else to add there, Emma?
Yeah, this one, this is a very incomplete explanation, and that's what happens when you try to simplify things is you're going to miss a lot of the nuance. But if I'm explaining this to somebody for the very first time, normally what I will say, it's like the average annual return that you get on an investment if you factor in how long it took you to get that return. So it's basically take the equity multiple and factor in time. And the reason that I like it is because everybody can understand. If you're invested for 5 years, you put in $100,000. At the end of that, you have a 2x return. You have $200,000. Where you're going to take that 100% return, you're going to divide it by 5 because that's how many years it took you to get that, and it's going to be 20% per year. Now, if it takes you 5 years to get that 2x return, that is going to be better than if it takes you 10 years to get that 2x return. And so that's what basically what this is doing is taking your total return and factoring in the time value of money there. So I think also IRR tends to be one of the things that people latch onto because it's a percentage. It'll be like 15% or 18%. And they say, oh, well, that's great. That's going to make a lot of money. And it does not take into account risk at all. And so people sometimes are just looking for a higher IRR, but some of the riskiest deals come with high IRRs. Now, you could also have high returns on a deal that just has really low expenses. We'll see that in RV parks, things like that, where the expenses are low, but they cash flow well. It really depends on the asset. An asset that is more capital heavy and is more expensive to run is going to typically have lower returns. And so if I'm going to say, well, this mobile home park has a 25% IRR, but this apartment building only has a 15%, I'm going to choose the mobile home park, right? But that's not the only consideration. It just doesn't take into account risk or asset type or any of that. So it is a static metric that, again, needs to have some other things taken into account. People who like high equity multiples and high IRRs are typically what we call yield investors, where they don't really care how long it takes. They don't really care how much cash flow they're getting back. They just want to make a lot of money in the long run. Those are people who are maybe just starting their investing career, or they might be later on where they don't need the cash flow anymore because they have enough investments out there. So this doesn't take any of the cash flow or when that money is returned, it doesn't take any of that into account. And there's one more thing that you'll see with IRR sometimes that can confuse people. It's the XIRR. And what we do in real estate is typically the XIRR because it's measuring irregular returns. Take the example that we had before, where it was $200,000 coming back at the end of 5 years. You have a $100,000 profit, split that by 5, it's 20% average per year. But you didn't actually get 20% per year. That's the average. And so if you have some years you're going to get this much and some years you're going to get that much, it's going to be an irregular rate of return. And so XIRR is basically factoring that in. I don't see that a lot, but occasionally when I'm looking at a pitch deck or something, they will measure it that way to show that these returns are going to be fairly irregular over the period of the hold.
That's a great point there, Emma. I think that's with all, and it is important because and I'm glad you brought it up because I wanted to bring it up and completely slipped my mind, but understanding risks is extremely important. And there are different metrics. Typically, cap rates are one of the risk measuring metrics. And I don't think we're going to talk about cap rates, but I threw it out there. IRR, again, it is better to understand there is more risk. Typically, exactly what Emma said, the higher the return, you're typically going to take it on more risk with that return. And again, everybody is in their different journey. And Emma kind of nailed it on the head. Like, obviously, if you're younger or if you're like a high net worth individual, you're probably more apt to take it on more risk. And being able to, for me specifically, I like diversifying and having some risky some risky investments out there, but also backing it up with safer things like being the lender, right? Investing in debt or being the lender kind of helps mitigate that. Should something happen, you still have cash flow, so you have a equal good balance between everything.
Am I doing this one or are you doing this one?
You are.
All right. Cash on cash return. This is our pet metric right now because when my husband left his W-2 job, we suddenly went from yield investors to cash flow investors. Another word we like to call cash flow investors are coupon clippers, because they're your average run-of-the-mill retired person who really just needs to have consistent cash flow coming in. The trade-off for high cash flow is typically a lower yield. And so take, for example, when we're doing private lending, we're getting a 10% return on our money. I could go invest that and in a 5-year project and make 18%, but I'm foregoing that because I really want that reliable cash flow that just comes out from those debt payments. And so finding a deal that is both high cash flow and high yield is a little bit of a unicorn. When we find one, like the RV park is probably the best deal I've done as far as balancing high returns with high cash flow. We'll jump on that because you don't usually find them in the same deal. So cash on cash return is referring to the amount of cash flow you're getting per year divided by how much you put in. And it comes out as a simple percentage. And you'll see patterns as you start to recognize these in deals. When I first started in 2018, a 10% cash on cash return was pretty standard. And then as prices started to go up, then people were finding that, okay, well, yeah, I'll take a little less cash flow because otherwise there are just no deals. And the cash flow was starting to get kind of low. You started to see 7%, 8%, and when everybody was doing 10 or 12 a few years ago. And then as the interest rate markets shifted and monthly payments went up higher, it was eating into that annual tax pre-tax cash flow, and those cash on cash returns, which were already kind of low, sometimes got hit even worse because the mortgage payments were going up. So it's like, how much money do I have to put in here to make this much per year? And I refer to that as trading large chunks of money for cash flow. You're going to put a big chunk in and you're going to get little bits back, swimming back every single month. And the higher that percentage is, the higher cash flow it has. And so some people care a lot about cash flow. Some people don't care at all. When my husband was still working, we did not care about cash flow at all. I just wanted yield because we were trying to get him retired as fast as possible. And then when he retired, we're like, oh, well, I guess we're coupon clippers now. So that can show how your investing journey can change based on where you are in the life cycle. And in a couple of years, once we get our cash flow where we're really feeling much more comfortable, we'll probably start to switch over to the yield investing a little bit more. But especially as our net worth goes up more and we have large deals coming back and a chunk of money here and a chunk of money there, plus some decent cash flow, that's when you start being able to really not care about cash flow anymore. So I imagine we'll eventually get back to the yield, but it's important to know where you are in your investment journey so that you can make decisions based on what's best for you at the time. And switching over from yield investing to cash flow investing, it's a process. You don't all of a sudden say, all right, tomorrow we're quitting our job and we're only investing in cash flow, because if you haven't been doing it already, then it's not like you can just turn around and start doing it tomorrow. So we started preparing almost 2 years before that anticipated retirement date, focusing more on cash flow. And it's been very psychologically difficult to focus on a cash flowing investment versus a yield investment. And I'll be looking at these higher yield deals and I'd be like, oh, I really would love to throw some money in there, but we need the cash flow. So psychologically for me, it's been very challenging. And so the psychology oftentimes comes into play when we think these are just financial metrics and your goals and your journey is going to change. Your psychology also is important to pay attention to how you're feeling about a deal. And this is a perfect example of where we struggle with our emotions when we're making investment decisions. Chris, do you have anything to add about cash on cash return?
No. Yes, I do. But sorry, I had to take a puff of my inhaler.
Oh,
No, you're good. You're good. I think one of the things that maybe, well, you didn't necessarily talk about yet. I think cash on cash could be an indicator of risk as well. In when you're looking at the deal overall, and what I mean by that is, if it's a high IRR and a very low cash flow, typically you're going to be taking on much more risk. The cash flow, and obviously you would have to look at more the deal in more totality than just that. But the cash flow, again, you can have we're going to have cycles in the market. It's always been there. It's never going to end. The markets are cyclical. The one thing that can mitigate it is time and cash. Well, again, that's two things, but the two things that can mitigate it is time and cash. If you have the cash reserves, or the property has enough cash flow to manage any ebbs and flows in the market, then you're going to be absolutely fine. And I've never heard of someone who held onto a property for 10 years and said, darn, I wish I didn't do that. Like normally, I mean, if you can hold onto a property for long enough and weather any storms, then regardless of the cyclicality of the market, you're going to be absolutely fine. Okay, next we have Waterfall, and Waterfall's probably as outside of IRR is probably the second most, or maybe even one of the most confusing things about
Yes.
a real estate syndication. So instead of describing the terminology behind it, which I think would probably just equally make us more confusing, I put together a cool little skit that I like. It took me a while to do it, but cool little skit. So we have two people. So we have a GP or a sponsor, which is George, and then we're going to just have Aunt Sarah. So we need private equity partners in my scenario just to kind of explain it. So George's sponsor, he goes out looking for a property. George doesn't have a whole lot of money. He has some money, he has about 100,000 to invest. And then he's just like aggressively out there looking for a property. And he comes across this cool white brand new building that he's going to buy for a really dirt cheap price. But they evaluate the property, he gets super excited. He believes that in the property, he can come back with a 19% IRR with a 5-year hold. Again, the issue is this, and this property, you're not going to be able to find this property for $4 million, but I wanted to keep the math simple. So he finds it, it's $4 million. And then even if he can buy the property at $4 million and get the property, the debt on the property at 75% loan to cost, he's still going to need $1 million. But again, issue is George only has $1 million. So he needs to go out and look for equity partners. He has Aunt Sarah. Aunt Sarah owns a bunch of businesses, super busy, and has a boatload of money. I don't know what business does Sarah own? I don't know.
She's a realtor, and she's a real estate broker who owns a few car washes on the side, and she just doesn't have time to learn another business.
Sarah does not have time. So George calls Sarah up and goes, "Hi, Aunt Sarah. I'm looking at buying this beautiful apartment building. How would you like to make 19% on your money?" And Sarah says, "Okay, how much do you need?" She's like, "Well, I need $1 million, but I have 100,000 of my own." So, okay, this is the way the math breaks out. So George is going to buy the property for $4 million. $3 million of that will be let's just say bank debt. $1 million of that is your equity. And then this is where we talk about what is debt, what is equity. Hopefully this helps that out too. Aunt Sarah is going to bring in 900,000 and George is going to have 100,000. So you're like, okay, and Sarah, if you were to invest this $900,000 elsewhere, how much would you make on that return? So Aunt Sarah thinks about it. She's like, I think I would make about 8%. Perfect. That's what we call preferred return. So that's where the preferred return comes in. So until we hit this 8% IRR, how does this sound, Aunt Sarah? Let's split the profit 90-10. I'll take 10% of the cash because I put in 10% of the cash, and you'll take the other 90% of the cash. How does this sound? It's like, oh, that sounds really good. Thank you. So now George says, wait, but I have to do all of the work on the property. This is where kind of that promoted interest comes in. Since I'm going to be doing most of the work, if our investment goes over that 8% that you would have gotten anyway, I'll take 30% of the profits and you take 70% of the profits. How does that sound? And Aunt Sarah's like, oh, that sounds great because regardless, I would have made only the 8% anyway if I was to go out and do it, the investment elsewhere in the equities market. So the promote side of it, I would say, think of it like a bonus for doing a great job. So that's where the whole promoted interest comes in. So kind of let me just break this down on how the math works. So for every dollar of profit over the 8%, George is going to receive 30% of the 90%. So again, 30% times 90% is 27%. And then you're going to take that 20%, and this is over, again, understand this is over that 8% IRR. George is going to get 27% of that, plus he's going to get the 10% of his original capital invested. Is that making sense so far, Emma? Are we good? Okay, perfect. Um, now, let's just fast forward 5 years. The property maybe didn't do as well. And again, I'm trying to make math super simple for me here. And instead of the 90%, he hits a 6%, sorry, a 16% IRR. Still like a super good profit. So over the 5-year period, he'll have $1 million worth of profit. Now, how is the profit going to be split up? So you have 400,000 of the profit is up to the 8%. So just looking before it hits the 8%, on Sarah, on her, the money she invested, she's going to get 90% of that 400. So she's going to get 360,000. George, who's the sponsor, again, he pulled up the initial 10%. He's going to get 40,000. So there's your full 40,000. Now, the profit after that, again, is $1 million. The profit after that is $600,000. And this is the profit over the 8% IRR. Now, as you guys remembered earlier, George is going to take 30%, that promote portion, the 30% of Aunt Sarah's 90%. So on the 600,000, Aunt Sarah's going to get the remainder, which is the 63%. So she's going to make a 378,000 on that. Then George, the sponsor, he's going to make a total of 37% on the 600,000, so 222,000. Still a really good payday. So Aunt Sarah, on the money she put in, is still making 738,000. I didn't calculate the equity multiplier. It is slightly under 2. And George is going to walk away with 262,000. So again, the waterfall structure is basically how the splits are going to happen. And there's honestly a plethora of waterfall structures out there. I would say this is probably the most typical. The splits are going to be a little different. They're going to look a little different, but this is probably the easiest way for me to articulate exactly what a waterfall structure looks like and kind of give it in real world scenarios. Because if I just explain what the terminology was, it still would go over. It would definitely went over my head. And
well, I like to start at the most basic level. The reason why it's called a waterfall in the first place. So imagine that you're out in nature and you're seeing a waterfall. And maybe it's more of like a brook, and the water's coming down and it's hitting that first rock. And then it splits as it goes over that rock, and it goes down and it hits a next rock. So each level is kind of dropping down, and the flow of the water is changing every time it hits a rock. So those rocks are like these hurdles. So the first rock is, we need to make at least 8% on here. You're going to get all the money up to 8%. The second rock is, okay, I did a good job. We made over 8%. So now we're going to do some sort of a split. It's the 70-30 split or something like that. And so you'll start to be seeing that these waterfalls can get pretty complicated. And sometimes they can be so complicated that they confuse investors, and investors are like, I don't even want to invest in this because I don't quite know what's going on. And so the reason that we put waterfall as one of our top 4 is because when you're looking at a pitch deck, you'll often see the equity multiple, the cash on cash return, the IRR, and then you'll see like a 70-30 split. And that's what it's referring to. Or sometimes you'll see a preferred return and then a 70-30 split. That's referring to the way that the money is split up, and each of those rock hurdles are incentivizing the operator to do a better job because he'll get paid more. One thing that's important to note that you're not usually going to see in a deck is that the percent returns for the general partner or the operator tend to be higher. So you'll see here that Sarah got just under a 2x equity multiple, but George actually did better. He got more than a 2x equity multiple, but he put in a lot less money. So while the partner put in more money and they're going to get more money back, the general partner puts in less money and they're going to get less money back, but they typically are a slightly higher rate than the limited partners. And so what you're going to see is a blended return is going to combine what the limited partner is making with what the general partner is making, and they're going to blend that into a total project return. Some people really do care about this because you want to make sure that the general partner is getting paid enough to want to do a good job. If they're giving too much money away to the limited partner, things start to go bad. I'm hardly making any money on this anyway. unless they really love their Aunt Sarah. Sometimes they just don't have their eye on the ball, or they get a new project that's better. So being aware of the total project return and how that splits out to GP and LP can be an important risk management factor. So that's where Waterfall can help you manage risk as well.
Absolutely, absolutely, and I'm glad you kind of brought that in. I'm going to full circle it in as well, because it is important for, like, you might look at this, because again, I didn't calculate it out, but this is going to be roughly about a 60% return for the GP, exactly what she talked about. But it's honestly important because it's exactly what Emma said. You want to make sure that, well, one, you want to make sure the sponsor has skin in the game as well, because it's exactly what Emma said earlier. If they don't have any skin in the game, then they can just walk away from it. So you want to make sure they have monetary skin in the game, but you also want to make sure the sponsors being compensated as well. Because if they're not really compensated, it's exactly what Emma said, that they can say, well, I'm not making much money on this anyway. I can just walk away from it. So worst case scenario is they have zero skin in the game and they have a low return profile. Again, they're not going to be as vested into the project as you would want them to be. So having multiple hurdles, it's not uncommon to have 2, maybe even 3 hurdles, depending on what the IRR metric is. And they can go forever. It can be cash on cash. It can honestly be a multiple. You can even have multiple hurdles. One, probably the most beneficial to the investor is both an IRR hurdle and an equity multiple hurdle combined together. But it gets more complicated, and you're like, I don't, exactly what Emma said. I have no idea how to calculate this, so I'm out. But it is important to understand that the ultimately what Emma said was 100% correct. It's us giving you the information so you can make a fair assessment. Is this the right opportunity for you? Is this the right deal? Am I taking on more risk than I want to take on? Go ahead, Emma. This is you.
All right. This is my new home, y'all. We are proud Texans. 5 of our 6 children were born in Texas, and we were driving back into Texas today after we crossed the Louisiana border. And my kids were all looking around like, I feel like I'm back home in the place where I was born. So we just got to this RV park earlier this afternoon, and we are going to be boots on the ground here for a while. One of the nice parts about real estate investing is we've been able to travel full time for this past year. And we bought an RV a couple of months ago and started driving around the country in an RV. And we thought, hey, let's go over and do boots on the ground. So having boots on the ground is really important. Somebody needs to be able to show up and make sure things are going well. And this one is getting some extra special attention from us, the owners. So this is an RV and storage park. It's on Lake Fork in Alba, Texas. It is either the largest or top, a couple of top bass fishing lakes in the United States. It is RV Mecca out here. People coming in, and there are bass fishing tournaments almost every single day of the year, and people are always looking for a place to stay. This is a mixture of long and short-term rentals, mostly long-term. We have a few park-owned units and a few short-term spots for people who are coming in during the height of the fishing season. One of the things I like about this deal, probably my favorite part about this deal, and one of the reasons the cash flow is so high, is because we have seller financing terms. It's a fixed rate at 4% for, what is it, 15 years, 13 years?
13 years.
Yeah, that loan does not exist in commercial real estate. I know that sometimes people who only have experience with residential may be thinking to themselves, what's the big deal about this? Residential loans are 30-year loans, and you have 30 years to pay them off. It's amortized over 30 years, and it's a 30-year term. And so it's fixed rate. Maybe it's a 7%, right? Which right now is not that great, but you have 30 years to pay off a fixed term, a fixed interest rate. Commercial loans do not work like that. The terms tend to be 5 to 7 years, 3 years. I mean, I've seen a few local banks do 10 years if you're willing to sign a personal guarantee, but you're often going to have a fixed rate for only a portion of that. So it might be interest only for the first 2 years, and then you're going to switch to some sort of variable rate. And then if you can refinance to long-term fixed debt in the commercial real estate world is anything that's fixed for like a 5-year term. So amortized over 30 years, but you have to pay it off every 5 years. And this is one of the struggles that we're seeing right now as the economy is struggling a little bit, is loans are coming due, because we didn't get 30-year loans on our multifamilies. We didn't get 30-year loans on these things. They're coming due during a a time where you have to refinance or sell that thing when interest rates are high, and we have no choice. There's really no way to renew, extend. And so this gives us so much, not only risk management, but a 4% rate, again, over 13 years. That does not exist in commercial real estate. And that's why this deal is so good and so low risk. So that's my favorite thing about this deal. It's basically a reliably cash flowing business. It's already spinning off cash flow. We do have some light value add stuff that we want to do. We can add a few additional spots. We're trying to assess the ROI on some various options that we have there. And we're going to be doing some property improvements, like just beautifying it, making it look a little bit nicer, and just upping the level a little bit. But we don't have to do much. We're not planning on turning this into the Taj Mahal of RV parks. It's just like a car wash type of cash flowing business. Also, it's visible from the highway frontage. It's next door to the public boat ramp. I can actually see it from my RV where we're hanging out. And it's very high occupancy. It usually has very few vacancies, and people are coming in and doing short-term stuff during a portion of the year. So it's just a solid, reliable deal. I think the only thing I don't like about it is the beautify part. Like, I'm really excited to come in here and just and fix it up as much as we can, but we don't want to overdo it, right? Lots of RV parks around here. We have great comps, and we have a great ability to just drive over to the neighbor parks and see what they're doing and kind of copy that a little bit. And so I feel like this is just a solid play. Like I said, it's the best deal that we've ever done that combines both high returns and high cash flows. So we did buy this in December of 2023. We are doing a cost segregation study. We will be passing along that depreciation. And what's the date? What's the cutoff date that they can invest and still get 2023 depreciation? I don't remember, but it should be. I think it's in the end of January. But you tell me.
I believe you're correct, and I want to say the cost seg estimation came out at about 70%,
which is extremely high. It's extremely high.
I was surprised.
Yeah, I know. Remember, we were talking about, do we even want to do a cost seg study, because there's really nothing out there. But you'll be surprised. We've got a bathroom building with the laundry. We've got sheds. We've got the storage units. We've got the storefront. We have like 6 mobile homes that we own. The docks. I mean, there's the road, the sewer system, the underground plumbing and the electrical. I mean, there's infrastructure there that is all depreciating. And RV parks tend to depreciate actually at a really, really high level. That's not uncommon. And so it's got great depreciation as well. So that basically means if you put in $100,000, 70% of that basically gets to offset any of the income that you make off of the park. And so usually when it's that high, it's more depreciation than you can even use. So it's it checked all the boxes for us. So we really, really like this park, and we're probably going to be here for a couple of months, just making sure that it's nice and pretty.
All right. You want to close this out? I say let's close this out.
All right. So we made this QR code thing for you. Really, really easy. Just hold your phone up to the screen. If you are an accredited investor and you're looking to be hands off so that you can enjoy more time with your family, doing the things that you really love to do without having to worry about having a real estate side hustle, then that's exactly the type of investor that we are helping. Like, we are full-time at this, and we understand the pressures of job and family and all of that. And when I was starting my real estate business, I had to ask myself a lot of questions. Do I want to run a real estate business, or do I want to do my other career? And everybody has to answer that question for themselves. And oftentimes the answer is you're making a lot of money at your job or your business, and you really just do not want to start a real estate side hustle or change careers to become a multifamily operator so you can understand all the mumbo jumbo that we just got done talking about. So if that describes you, we help you retire early, gain financial freedom, and really be able to have more freedom about the choices you make, about where you want to work, how long you want to work, how you want to spend your time, and who you want to spend it with. We have done that. Chris and I have both done that. So I think one of the unique things about our fund versus other funds is we're not out here teaching you how to do something and peddling the dream of financial freedom and early retirement, hoping that someday we can gain the same thing. We already did it. We already retired early on income that we were able to generate from our business and investing activities. And now we're working because it's our passion project to help other people do the same thing. And we walk our talk. And so that is one of the main reasons that we now are obviously continuing to invest. We would be investing in these things anyway. That's how we retired early. But to be able to open up a fund where we can share that with you is a really important part of our mission to help as many people as possible reach financial freedom so that you can go out and pay it forward to the next group of people who will say, hey, how'd you do that?
That's awesome. Well, I really enjoyed the time we had here, kind of just educating everyone. It was just a lot of fun. I think you closed it out extremely well. Just our goal, and again, both Emma and I are retired ish, and I guess this is what retired life look like.
This is what it looks like.
Yeah. But it's honestly to drive our passion, and our passion is to be able to give more, put more, do more, and just have more opportunities to be able to share with other people. And honestly, genuinely, and that was the values. That was honestly the core values that brought us all together. So our entire group share the same values and the same sentiment. So I think you just closed it out absolutely perfectly. I just want to tell everybody, thank you guys. Those of you that jumped on, thank you guys for jumping on, spending your Thursday evening with Emma and I. Really appreciate you guys making the time to come out and just join us. And hopefully you guys got some valuable education out of it. And hopefully the next deal that you guys do with us or without us, you guys are just that much more prepared for the opportunities that are going to get bestowed upon you. So again, mahalo nui loa, everyone, for jumping on. Thank you, Emma, for spending the night. Really appreciate everybody. And you guys have a great night.